Welcome to Mortgage Markets and More. Happy Friday, everybody. I'm your host, Peter D'Angelo. I hope you're all having a wonderful week. I don't know about you, but I, for one, am very excited to not see any more election ads. We've got our president-elect for next year, and today we are not going to talk any politics. We are going to talk purely about numbers, monetary policy, and all these things that are very important to us in the real estate and mortgage worlds. Without further ado, here is our survey of mortgage rates as of recording this podcast on the Thursday before its release. And again, according to Mortgage News Daily's survey of average mortgage rates across the country. Starting off with our 30-year fixed rate average mortgage rate, we are at 7.13%. The 15-year fixed rate is at 6.55%. The 30-year jumbo is at 7.25%. The 30-year FHA is at 6.62%. And the 7/6 SOFR adjustable rate mortgage is averaging 7%. All of these are up slightly from the week prior. And before we go into the bond market, we're going to save that for a minute. I waited to produce this episode for you today so that I could report out after the Fed makes their decision and announcement on their monetary policy. And as everyone has been expecting, the Fed cut their benchmark interest rate by 0.25%, 0.25%. We were at 4.75% to 5%, and now the Fed fund rate is within the margin of 4.5% to 4.75%. Why did the Fed do this? They made their announcement and they added the additional color that the labor market is remaining consistent. The indication that we had when there was the 0.5% rate cut back in September was, swirling concerns around the labor market because of the jump in unemployment. However, that's been quelled. The unemployment report that was furnished on Friday last week after the release of my episode came in at 4.1%. So as we talked about, that was the lowest unemployment rate ahead of a general election in about 24 years with the way the election cycle works. Additionally, they are comfortable with the progress that inflation is making, albeit it is slow and it is mixed. We went through that data last episode. They are still content with the fact that inflation is showing progress toward the 2% goal and 2% target. Though we are not there, they still thought it was appropriate to cut the benchmark interest rate by 0.25%, and a lot of that stems from hoping to stay ahead of causing a recession, as typically happens historically when the Fed goes on an interest rate raising campaign to tamp inflation or respond to other types of economic pressures to try and help the economy. And normally when they start to cut their interest rate, that precedes a recession a lot of the time. And this was a move that, unlike what happened in September, this was a unanimous vote by all Fed Reserve members. Last month in September, we saw that Michelle Baumann, one of the Fed governors, actually dissented, and she did not support the 0.5% cut. This time around, everyone was on board for this 0.25% cut. So now we're 3/4 lower than where we were before they made their first cut. We're really not feeling any of that relief, and I know it is perplexing because you would expect that if the Fed had cut the interest rates, then we're going to see mortgage rates come down, financing rates come down. But there's a couple key things to keep in mind. One, the Fed fund rate informs short-term lending, which does have implications further down the line for longer-term lending, but by and large, we're talking about short-term lending. Secondly, expectations. The market expects certain things, trades accordingly. They were expecting the Fed to make the rate cut. That they did, albeit it wasn't unanimous that everyone thought, we're going to see a 0.5% cut coming out the gate. A lot of financial analysts and other economists were expecting something like 0.25%, but saw a good case for 0.5%, especially after we were getting those unemployment figures and things. With the state of affairs right now, there's a couple concerns that people have. We have a new administration that's coming in, which could have impacts on federal spending, which also informs the deficit. Government debt is bonds. So when they need to fund, they're going to be issuing bonds for a market to purchase so they can fund their budget. If we're going to have continued deficit spending, it's going to be more bonds. If you increase that supply, the price will go down and the yields go up, and that informs interest rates for all types of financing. The other thing that is a concern right now is still that we're not at the 2% target. Inflation is sticky, and with further government spending, there's concerns that we could see inflation start to tick up again, which would create some complications for the Fed in particular as they've started to ease their monetary policy. They are staying the course. Fed Chair Jerome Powell mentioned in his announcement that they are staying the course with peeling back their purchasing of bonds and mortgage-backed securities, which will leave more room in the open market. More room in the open market means more volatility. We could expect to see interest rates continue to remain at this level and until we start to see a tangible change, meaning unemployment ticking up further weakness in the labor market. We now know that that's quite a bit more important, it seems, to the Fed than, let's say, inflation coming down and actually reaching 2%. They're going to keep an eye out on the labor market, even though they have a dual mandate where they need to serve both masters and try to bring inflation down while not causing a large influx of people losing their jobs. Last week, I mentioned the unemployment came in at 4.1% for that monthly reading. The weekly reading on initial jobless claims was 221,000. That was just up a touch from last month, the last reading a week prior, and also where expectations were. Expectations were at 220,000. You can consider that completely met expectations. Other things that we need to consider right now in the market is the risk factor. Bonds are what's called a safe haven asset. If there's a lot of risk in the system, people will then flock to bonds because it's stable. You have a security instrument, something you're investing in that is going to be backed and that is backed by the full faith and credit of the U.S. government when you buy those bonds. Foreign investors and stateside investors alike in individuals. If there's more risk, then people are going to go into bonds. However, what we've seen in the stock market is the day after the election, the Dow rose 1,500 points. That's incredible. And there was already a lot of value in the market, and it just increased. We're going to have to see what cabinet positions look like and expect a lot more volatility pretty much from here to the end of the year. We're going to probably get news that's going to move the needle quite a bit more than we have over the past 60 days because of this factor and because of the fact that individuals, analysts, economists, investors are all going to be very sensitive. And I'm sure the algorithms are being trained and being created in a sensitive manner because of this, while still trying to strike that balance to get as much out of any run up on the stock market that may occur. I want to also share something that was very interesting from this week. The National Association of Realtors released their 2024 buyer profile. And in this report, I extracted a couple key pieces of information that I thought was fascinating. So let's actually look at some of this information now. First-time home buyers, their share of the market in their assessment and in the data that they collected at the National Association of Realtors fell to a low of 24% of all transactions. That's down from 32% in 2023. Secondly, the average age of the buyer. First-time home buyers, the average age, 38 years old. And the average age for those with subsequent purchases, 61 years old. Both of which are much higher and nearing record highs. The first-time home buyers, in particular, that is probably indicative of the fact that it's so competitive right now, and that's why their ownership share of how many, of all the transactions performed in this survey, they're only 24%, down from the 32% in 2023. Other things to consider are that the subsequent buyers do have access to a little bit more capital, which I'll get into because some of these other data points start to show us that. Down payments. They performed a survey, and on average, first-time home buyers are putting down 9%. That is the highest since 1997. Repeat buyers. These are individuals who have purchased a home and now purchasing a new home. They are putting down an average of 23%, which is also the highest since 2003. When we take a look at everyone, the average down payment, or rather the median, the number that occurs the most, is 18%. Why are first-time home buyers having so much trouble in the market? Take a look at these down payments. Higher down payment means a stronger buyer and a higher likelihood of having your offer accepted. If they are competing with the individuals who are purchasing subsequent homes, that average is 23%. That's quite a wide disparity. Albeit the repeat buyers could be purchasing second homes and investment properties, things like that. The point still remains. The competitive nature isn't just a matter of inventory. It's to fight for the inventory that is there, requires a lot of cash to compete with some of these higher down payment offers. Cash purchases hit a record. 26% of buyers paid in cash. I'm going to stop there because if we take a look at the subsequent buyers and the cash, let's think about why this could be happening. If you're a subsequent buyer, you already own a home. Home values have gone on a bull run up, and we've seen a ton of home equity increase across the whole country. And so those buyers are in a position to, when they're selling, they can use their equity in that property they're selling and shift it over to the new property, which empowers them to make larger down payments. If they are not going to sell their property, they do have access to other loan products like HELOCs, home equity lines of credit, and second mortgages that allow them to tap into their home equity that can help them fund the down payment for that subsequent purchase. In some respects, maybe they're using their current home equity to make all cash purchases. And this is what continues to create this affordability friction and the competitive market that we're seeing. 17% of buyers purchase multi-generational properties, which is an all-time high. A multi-generational property means a son purchasing from a father or mother. It's relatives purchasing property. And that's at an all-time high. It does make sense. To be in the open market, you're paying a premium. You're bidding up. If you have family that's looking to sell their property and they want to help a family member out, they're going to go and they're going to purchase that property or work it out. The challenges are not elusive to us. The challenges that are presenting the buyers in this market are what we've been talking about ad nauseum at this point, weeks on end. High interest rates, high prices, low inventory, pent-up demand that keeps the competition very, very high and continues to climb because the demand continues to increase. Other things to consider are the fact that we have mentality shifts that seem to be occurring. The spread between what it costs to rent versus owning is still at one of the widest points. Even though rents continue to go up slightly, there's still a wide spread, and the affordability of purchasing is a little bit higher than rent. And for some, it makes more sense to continue renting, and that kind of takes them out of the buyer pool. Albeit, those are still individuals and families that I would consider in that pent-up demand category, even though they're not active buyers right now. It's something that's probably on their horizon, and it's purely a function of the current economic environment that has them moving forward and renewing their leases or finding a new lease. Now for our Did You Know segment. I am excited to share and continue our conversation from last week. For those that would like to have a little bit more detail, I'm going to skip a little bit here because last week we went in depth and talked about appraisal waivers from a contractual standpoint. What is an appraisal waiver when you're placing an offer and the benefit that it provides in helping you to be more competitive in this market. If you're interested, check out last week's episode. Skip toward the end of the episode. You'll be able to find the spot where I present the Did You Know section and talk about appraisals. We're going to take that a level further, and instead of talking about the contractual side of appraisal waivers, we're going to talk about the lending side of appraisal waivers, which is a thing. Yes. So we talked about last week, you can place an offer with an appraisal waiver. Reader's Digest version is you're telling the seller, regardless of what the appraisal comes back at, you are agreeing to purchase the property at that price. Done deal. If there's a shortfall, last week we talked about ways to navigate that and some strategies that I employ for my clients and the families that I help. Today, we're going to talk about the appraisal waivers on the lending side. In our process, we qualify our buyers, the families that come to us to seek financing to get pre-approved, and we'll load their information into the system. And then there's something called an automated underwriting system. It's a jacked up computer system that reads all the loan data and lets us know, yes, you've got a good loan. It meets all of the guidelines required. So this loan is good, and it is a loan that is backed by Fannie Mae, Freddie Mac, or the FHA. We're going to talk conventional now. So conventional is the Fannie Mae, the Freddie Mac, your garden variety, standard conventional loans. As it currently stands, you can place an offer. One part of the due diligence that I perform for the families that I help, I will load into the system what the current address is, what their circumstances are. I have their whole application put together, their purchase price, down payment, the whole nine, and then I'll feed it into that underwriting system so that I'll be able to know before my clients submit an offer if I get an appraisal waiver in the system, which means that the automated underwriting system says to me, we're good. We don't need an appraisal on this one. The purchase price for this property falls well in line with the market, which the automated system has access to a whole database of appraisals performed for the past 15 plus years and generates market trends based upon that and is able to give that response. Currently, here are a few things that I've been able to identify for a high likelihood of getting an appraisal waiver. 1, 20% down payment. Having 20% down payment seems to be an integral piece. So you really need to have 20% down for there to be a shot at getting an appraisal waiver. Secondly, credit scores. Typically 720, 740, but really 740 and higher gives you a higher likelihood of getting an appraisal waiver. Third, debt to income ratio. Typically I'm seeing 45% debt to income ratio or lower, which is when we compare gross monthly income of our clients that we're helping and compare that to the proposed debt of the property and all of the debt that's currently reporting on the credit report across all three bureaus. If that ratio is 45% or less, high likelihood of getting an appraisal waiver. Lastly, and this is one that's a little interesting, it has nothing to do with the buyer. It has everything to do with the property. If the property hasn't been sold in the past 15 years, very likely not going to get an appraisal waiver, because if the property's been sold in the past 15 years, it's very likely that the appraisal that was performed at that time had been uploaded to this database as is required as part of the process. And if that data is in there, there's trending data for the whole market with other transactions happening in a market, and the automated underwriting system can make a good educated guess to say, well, this purchase and this transaction is well within range of value. You have an appraisal waiver. That's how they work. We just got an update from the Federal Housing Finance Agency this past week that starting in 2025, the first quarter, there's going to be updates. And they specifically provided us with some parameters that is really amazing. And this is going to all tie back to that homebuyer profile that we were talking about before from National Association of Realtors. What the release showed is that now there's going to be the possibility and a higher likelihood of appraisal waivers going all the way up to 90% loan-to-value ratio. Loan-to-value ratio is when we compare what your mortgage balance is to the intended purchase price. So for us, a 90% loan-to-value ratio equals 10% down payment. Yes, you heard correct. Now it means that there's going to be possibly a higher likelihood of having appraisal waivers offered to the 10% down buyer and up. We just covered that first-time home buyers' average down payment is 9%. So now first-time home buyers could, I've got glass half full. I'm looking very optimistically at this. This could pave the way to start allowing and empowering our first-time home buyers who've been battling it out to try to win and try and get their home in this competitive market. This could pave the way for them to now have the ability to know from the jump They don't need an appraisal. They can place that offer with an appraisal waiver attached to it with no stress, no concern. If you don't have the appraisal waiver on the lending side, like I'm talking about, you may have some concern if you have to get an appraisal done and having to navigate. Albeit, I provide you with the solution last week that'll do the trick. But this is awesome because now first-time home buyers have the ability to proceed with a little bit more confidence and a little bit more strength and be a little bit more sharp in this competitive market. I'd like to close today covering and tying in a bunch of these things. We heard about the Fed. They cut their benchmark interest rate. We talked about the home buyer profile when we look back over the past year for 2024. And now we have some updates coming on the lending side that could be helpful. Where are interest rates going? And this is a conversation I've had a lot lately. And I think that it's tough to think about where interest rates are going to go. There's so much volatility. There aren't fundamentals in a way that will be beneficial for me to look at to give any sort of advice or opinion as to where interest rates are going that'd be really, truly valuable. So with all of that in mind, this is my recommendation. Interest rates have gone up and they are higher now. Expect this interest rate environment for longer. I made a case last week about why that could be good for the real estate market. If you're a prospective home buyer for your subsequent home or your first home, just expect this interest rate environment, maybe even a little bit higher, depending on how things transpire from now to the end of the year. But if you have that expectation, it'll be able to inform you whether or not now is the right time to buy for your personal budget. I think overall, now is a great time to buy because if and when interest rates go down, you will capture more home equity. Simple as that. But I'm leaning more and more into the side and into the mentality that maybe this is just the higher rate environment that is a new normal. But if there's an opportunity, now you know for sure, wait, I'll report out on a future episode. Let's say these mortgage rates come down. We start seeing a 30-year fixed rate averaging at 6.5%. Now you know, jump on it. Now's the time to make sure you get your pre-approval going. That may be the time to really give it all and give it all effort in the market to try to buy and just catch the opportunities if and when they happen. If you are committed to buying a home, whatever the price and whatever the interest rate may be, by all means, go for it. And the timing is going to be very important. If you have any remote interest in buying a home, I'll leave you with this. Get pre-approved. If it's 6 months, 12 months, even a year and a half from now, if you just know that this is one of your personal goals, we're coming down to the end of the year. New Year's resolutions will abound in the next 75 days. So if one of your New Year's resolutions is to put yourself in a financial position to be able to buy, you can start that process now and speak with a mortgage professional. Reach out to me. If you know someone, reach out to them, have a conversation about getting pre-approved. I can speak to what our process is, and there's no cost to it. There's no harm in going through the process. Our application experience provides you with a soft check on your credit, which means that you don't have to worry about an inquiry popping up on your credit report and negatively impacting your scores. So there's no harm and there's no risk, but there's a ton of benefit. You get to benefit by understanding what the budget is that you may have in your qualification. You have another benefit of getting to have the conversation with the professional, the mortgage professional that can guide you, where if your current circumstances aren't where you would love to see your purchase power, you can have conversations about what you can do to manage that. And then lastly, it gives you a check on your credit. You can get a sense of where things are at by way of your liabilities and what your monthly spends are, and you may be able to get some sharp advice. It's something that I do for families I assist all the time. Whether they're purchasing now or in a few months, I'll follow up when the time is right and when that timeline's established. But for now, hey, this is where your credit's at. If you do this, that, or the other thing, it could actually help bring up your scores a couple points, 10 points, 15, 20 points. Any increase in your credit scores yields better interest rates. The higher your credit score, the better interest rate you'll have available to you. So get pre-approved as soon as you start entertaining the idea of purchasing a home. The process doesn't take long. I'm able to turn around pre-approvals in less than a day. So it does not take that long. You can do it, and it's something that will benefit you greatly so that you can reach your goals and be in the best position possible when you are 100% ready to jump in with both feet and get into the market. That's it for me today. Thank you so much for listening. I appreciate you tremendously. If there's anything that you'd like covered on the show or any questions that you may have, please email me at peter.d'angelo@rate.com. I will be back next week with another update, and we'll see how things shake out after the Fed announcement this week. Otherwise, have yourselves an awesome weekend. Take good care.